Hey guys, one of the common questions I got from you through the emails you guys sent through was how much money do I need to start investing? And I sort of touched on it in the previous video when I said that like even if you're only putting your money in the bank, you're technically investing in that bank. So from my perspective, the way I see it is that if you have money at all, you're already starting to invest. And so the question is more, when should you start looking at different sorts of investments? Like as we spoke about in the past video, normally putting money in the bank is a safe investment, a safe-ish investment. And but I assume your question is more about when should I start thinking about investing in things like stocks or property or something of that nature. And so when approaching that question, I'll think about it from the perspective of, when it comes to investing, you just want to make sure that you're, one, obviously understand what you're doing. Two, trying to invest in something that you know has good value, so something that you understand and think will produce a good return over time. Or, and more importantly probably, is make sure you're buying or investing capital that you feel you don't have an immediate need for, because when it comes to investing, one of the key things is patience. And so and not ever being a forced seller, or trying to minimize your chances of being a forced seller, being that when you need to, you know, if you need to sell something to gain capital to pay for some other lifestyle expense or just your living costs or something like that. So that's what I think you want to try and avoid when you start becoming an investor. So you sort of want to have a bit more of a stable base, or a bit of a stable income. So from my perspective, if we're talking about stocks, because it's a pretty liquid asset, if you were to look at, I think once you have a reasonably stable income, if you sort of got the basics, essentials of life covered, in the sense that you might have the car you need, or you know, furniture for your home, and the clothes you need for work, and all those sorts of things that allow you to produce an income and live a stable life. And then once you start accruing a bit of capital, and by a bit, I mean, I think once you have about $5,000, if you've got, I think of it like, if you've got enough money in the bank to cover your living expenses for 3 to 6 months, that's about the point where you can start thinking, hey, you know what, I want to start diversifying away from just being in bank deposits, hopefully produce a better return than what you get out of a bank deposit. And also just start the learning process of investing. So from my perspective, once you have about $5,000, I'm not saying you put all that $5,000 in the bank. You might say $5,000 is your buffer. That's just your, you know, rainy day money. And then maybe the next $1,000, you're like, okay, I'm going to invest this in my first stock or my first share, or some alternative investment. But yeah, so once you've got a buffer, start thinking about it. So, but what I would do if I was getting into investing for the first time, buying my first company, buying my first stock, I would be approaching it not like you have to make money. Like, I mean, we spend tens of thousands of dollars on degrees to get an education, and the way I see it is that you'll be investing for the rest of your life. So don't approach your first investments thinking you're going to be super successful at it. Most people are probably going to lose money in the first couple of investments. Don't let that scare you off. Like I said, it's just a learning process. Think of it like an education. Just try to do it with a smallish amount of money that allows you to get a feel for how the stock market works, and how they produce dividends, or how they produce returns on investments, and how the prices move, and all these little things that you're probably going to have to learn at some point in life. Starting young is great, but with small amounts of money, so it's a low emotional investment, and just enough to give you a bit of skin in the game, so you start focusing on the mechanisms of finance and economics and money, and starting to understand these things, because they're essential to our economy. They'll be essential to your life, and it's how our societies work. So the sooner you do it, the better. Just don't put all your eggs in that one basket, and don't gamble your life savings. So yeah, and approach it with a philosophy towards learning and being ready to lose a bit of money. You might make some money as well, but don't expect that to be the case. It's not that easy to make money in any investments, and I think a lot of people confuse even some of the money they make in stocks or property or other investments they confuse it with inflation or just credit expansion within an economy. And so it's not quite as simple as a lot of people would make out, and the returns are not quite as attractive as many people imply. It's just that people aren't potentially measuring it correctly. So anyway, but the point is, yes, get involved soon, as soon as you are comfortable. And I think it's important to realize that if you look through history, like, and when I say history, I mean hundreds of years of history. I'm not talking the last 5, 10, 15 years. I mean, if you look at, I don't think you can really judge asset classes over those sort of short time frames. I think you really got to start looking at things over the 100, 200, 300 year time frame to really understand how our economic system works, how stock markets work, how property works, how agriculture, everything works, money. And once you look over history of that period, you'll start to realize that things like stocks, it's worth having them in your portfolio. They're not as high risk as people would make out. They can be volatile, but that doesn't necessarily mean high risk. High risk comes from when there's volatility and you become a forced seller. So if you might have taken out a margin loan to buy stocks. I don't recommend doing anything like that when you're starting out, or getting involved in options or CFDs or any of those sort of high leverage investments that I think a lot of marketing people might be out there pushing and promising huge returns. It's probably best to avoid them when you're starting out. Keep it really simple. Pick simple companies. Companies that have simple business models, and just sort of get into the process of picking companies that you could potentially read an annual report on and understand basically how they make money and why they might be profitable in the future, or when they might be under threat in the future, because essentially that's what you're doing when you're buying a company. You're buying part of that company, a stock, and you're going to share in those profits, and you own the assets of that company, so you just want to be able to understand what that company is and what it does. So in short, if you've got more than $5,000 to your name, you feel comfortable in life, you don't have too many big commitments, whether they're car loans, mortgages, kids. I mean, if you've got big commitments in your life and you don't, if your cash flow is pretty tight, I would say make sure you have a healthier buffer, because once you start bringing like debt, like a mortgage or kids and stuff where there's a real commitment that you need to have that cash flow coming through, you don't want to be taking on high volatility investments at that point until you have maybe a bigger buffer. But if you're young, if you're under 30, you don't have many dependents, and you don't have many commitments, maybe you pay back your student loans and stuff like that. I'd say get your buffer, put $1,000 in the stock market, and put some skin in the game and learn from the process. I'll leave it at that.